Which SIP can help you generate higher returns? Let's find out through a detailed analysis in this video. We all know that SIP is systematic investment plan and we can use it to invest in monthly, weekly or any specific intervals of time. But how we can use this strategy to generate higher returns? We will see this through 5 different perspectives. The first thing to consider is which asset class are you looking to start an SIP? For example, whether it is debt SIP or equity SIP. Debt funds are similar to RD and it can generate returns similar to FD. In the current scenario, debt SIP can generate only 6 to 8% return. At the same time, in equity funds, which is a stock market based funds, both the risk and returns are on the higher side. If you see from the year 2013 to 2023, the Sensex has given 12.6% returns. In the same time frame, the Nifty has given 12.5% returns. So when you take all this into consideration, there is a possibility for equity to generate higher returns. So we can comfortably say that investing in equity SIP has the potential to produce higher returns compared to debt SIP. The second factor to consider is whether to invest in short-term SIP or long-term SIP. The more you tend to lean towards long-term SIP, the rupee cost averaging works in your favor. Whether you invested when the market is high or in the middle or even when the market is low, you will still get the average cost price. So when the market is recovering, it will recover at a fast pace to give positive returns. Equity funds are generally for long-term investments and you should invest in at least for 5 to 7 years because it is a time frame for the market cycle. When you invest for 5 to 7 years, you are wholly committed to invest in the entire market cycle. So when you want to invest in equity SIP, you should think before that whether you can invest for 5 to 7 years. The third factor to consider is whether you are investing in SIP consistently or inconsistently. SIP is generally a method for consistent investment, be it weekly or monthly basis. Starting an SIP is just not enough. Consistent investment is the key to be successful. Some investors might stop their SIP entirely when facing financial difficulties. Others might think the market is not performing good now. Why should I continue my SIP? Many investors think, what's the point of still investing when my SIP is giving only returns on par with FD? But you should understand that the advantage of equity investment is volatility. If you want to take advantage of volatility, then long-term investment is the key. When the market is going down, you will be able to buy units at a discountable price. So you should definitely continue your SIP during that time. On the whole, SIP done on a consistent basis gives better returns compared with inconsistent SIP. The fourth angle that we are going to see is whether you should do a fixed SIP or step-up SIP. Fixed SIP is nothing but fixing a particular amount. Say for example, you can fix 5,000 or 10,000 per month and invest accordingly. But in step-up SIP, you are starting with a fixed amount, say for example 10,000. But as time progresses, you can increase it by 5%, 8% or 10%. So your amount is increased every year in step-up SIP. In fixed SIP, you can only invest a fixed amount, whereas in step-up SIP, you can change it according to the current inflation, the increment that you get, etc. When you started your SIP, you might be earning less, but now your income might have progressed significantly. You can step up your SIP and invest accordingly. So when you are investing a higher amount, obviously there is a possibility to generate higher returns. When compared with fixed SIP, step-up SIP is profitable. The fifth angle that we are going to see is whether index fund SIP or active fund SIP generates more returns. Index funds is a passive form of investment. For example, if we take Nifty 50, the fund manager purchases the same proportion as there in the index. His job is to simply cut, copy, paste Nifty 50. They will not analyze the balance sheet or check the profitability or sustainability of the company. Whereas a fund manager involved in actively managed fund verifies all such things. He analyzes the balance sheet and among 50 stocks, he finds the best stocks to invest. Why do we choose mutual funds? Because we don't have the knowledge or time to choose the right stocks and invest in it. So if the fund manager is doing the same cut copy paste, then what's the point of approaching him? If you invest in an actively managed fund, the fund manager will take full responsibility to choose the right stocks to invest. If you ask whether all active funds are performing better than index funds, then the answer is no. If the fund manager does not perform well, there is a chance of active funds doing poorly compared to index funds. If you approach a professional mutual fund distributor or a financial planner, they will help you in choosing an active fund that would beat the index. If you don't have such professionals to guide you, then you can limit your exposure to index funds. If you have a good financial planner to guide you, then you can continue your SIP in actively managed funds. The sixth angle that we are going to analyze is large cap, mid cap, small cap. Which capitalization of SIP will give higher returns? Large cap is a conservative equity investment where stability will be on the higher side. The volatility will be lower when compared with mid cap and small cap fund. Due to this, the returns will be lower than mid cap and small cap fund by 1 to 2%. Mid cap funds, unlike large cap funds, invest in mid-sized companies. When you compare with large cap funds, mid cap funds have higher volatility. It also offers better stability when compared to small cap funds. So we can say that mid cap funds offers more returns than large cap funds. At the same time, it possesses more volatility as well. Also, mid cap funds offer more stability than small cap funds, but the returns are slightly lesser than small cap funds. Small cap funds by nature is very aggressive. It has more volatility and have more chances of failure. Your amount is invested in small cap companies. In small cap stocks, certain stocks can turn out to be failure as well. So the risk is very high here, and at the same time there is also potential for a great return. So if you have a 10-year or 20-year time frame, then you can invest in small cap SIP. When you compare large, mid and small cap funds blindly based on returns, then only small cap funds offer better returns in the long term. If your investment time frame is 3 to 5 years, then even large cap funds can give higher returns depending upon the market situation. Whereas if your time frame is between 10 to 20 years, then investing in small cap fund will give you better returns. Just because the market has the potential to generate higher returns in the long run, an investor who is having a time frame of 10 to 20 years should not invest all his funds in the small cap fund. Because in small cap funds, there is a chance that investors don't even see any returns in the first 2 to 3 years. So it requires a lot of conviction and patience. It is a question mark. So that is the reason you should invest in large, mid and small cap in a balanced proportion, which is better for your portfolio to generate higher returns. If you give more weightage to small cap funds, then your portfolio turns out to be more aggressive. You would be pressured to withdraw your portfolio when actually it is the right time to stay in the market. So investing in large cap, mid cap and small cap in a mixed proportion is the best strategy for wealth creation. I hope that these 6 angles would have provided you with enough clarity to choose the mutual fund SIP that is better suited for your financial needs. If you have any other angle to analyze, then you can mention it in the comment section. I will meet you with another interesting video. Thank you. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation, and also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free, and you can find the link in the below description. Please like and share and do subscribe to Holistic Investment.